So welcome everyone to Does Your Family Have a Financial Plan for Alzheimer's? And I want to give you a little background on how this all came about. So I basically was working and having a conversation with Justin, and we started talking about elder care, senior care, expenses, how much of a legacy you can actually leave to your loved ones. And I relayed to him my challenges with my parents. What we ended up with is my mom had Alzheimer's, and 1 in 10 people over the age of 65 have Alzheimer's. And so, it's a scary thing. And my dad he did not want to move into a care facility to take care of mom because he thought, 1, he could do it, but 2, that he was afraid he wouldn't have any money to leave us. And so I reassured Dad, hey, that isn't what's important to us. To give her care is the most important thing. And so, we got him to release his clench on that concept. But the other challenge was that he was worried they were going to run out of money. And in all honesty, we almost did, because between mom and dad's care, it got pretty scary there. So I thought Justin, who's an expert in this area, could help us out with getting some more details. And just so you know, I cover a lot of these topics at a high level, as well as our specific experience in my book, It's Not That Simple: Helping Families Navigate the Alzheimer's Journey. So this book is actually what stimulated this conversation. So I hope you find it helpful. So let me hand off to my guest, Justin Smith, who's our financial expert today. Justin?
Hi, everybody. My name is Justin Smith. I'm a financial advisor and certified financial planner professional with Savant Wealth Management here in Phoenix. And Pam and I connected on this topic a while back, and it just made total sense for us to talk about the intersection of her world and my world, which is, having a care plan and a financial plan that can kind of work together. And my expertise is to provide guidance in comprehensive financial planning for high net worth families. And I work with people across the whole country. And I specifically help people who are in their 50s and 60s who are transitioning into retirement. What we often find is that those people often have to shoulder the burden of an Alzheimer's diagnosis in the family when it comes to their parents. So I've seen this tangentially many times over. And I think Pam and I have a lot of stories and experiences that hopefully you'll find valuable today.
So thanks, Justin. So what we're going to do with this format is really, right now you're on mute, but we can unmute you if you have specific questions. You can also scroll across the bottom of the window and click on chat and be able to ask your question in the chat room. So that gives you a couple of options for interacting. I wanted to keep this fairly casual so that everybody would have a chance to ask questions, because ultimately that's what we're here for. So let's kick off with, we're going to be here for about 20 to 30 minutes, and we're going to do Q&A at the end. But if you do have questions that you want to have answered earlier, feel free to put them in the chat, and we'll talk to those as once we get to the appropriate spot. So the first question that I have for you, Justin, the thing that occurs to me as we look at kind of a financial crisis, when we look at how much money do Americans put aside for savings for long-term care insurance. And so I guess the first question will be, what if you haven't even started to have a plan, either to, and haven't had the conversation with your parents or with your loved ones or your friends who might be older? Where do we start the conversation?
Yeah, and that's perfectly fine place to start. It's okay to not have a plan. You always have to start somewhere. And in a situation like this, when we're dealing with multiple generations, and again, it's that second generation, people in their 50s and 60s are kind of dealing with this. The best thing you can do is just start out with a general health assessment of the household. So usually that's mom and dad, and start to plot out what the next 5 or 10 years might look like, and asking yourself, who's going to need care, when may they need care, what about the other spouse, and then what's the total time frame. So you actually have two health tracks that you have to match together. And it's tricky because mom's health and dad's health are very rarely on the same track. They might have different issues, different ages. So it can be tricky. I like to just map that out. You can do that in a spreadsheet or just on a piece of paper, just map out, okay, what do I think might happen? Now you can't know possibly, but it's just a helpful exercise to get started. Then you can start to think about what are the care expenses that would be incurred over that time horizon. So Pam's going to talk a lot about how we can start estimating care costs, and we'll get into that in further detail. But that starts to give you a picture of, okay, what am I actually dealing with? How big is this issue? And you can break it down year by year. From there, you can say, what are the income and assets that are available to pay for it? So obviously, mom and dad's income and assets. Sometimes it might be the children's income or assets that are helping to pay for that too. It depends. A lot of times people might think that their health insurance or Medicare are going to pay for it. Generally speaking, that is not going to happen. We'll talk about long-term care policies in a little bit later, and that can be helpful, but that's not a panacea by any means either.
Right.
So again, we're trying to get that decade-long picture of what is this going to cost us and when. So an example, after we go through that exercise, you might project out 5 years worth of care, and that care might be $100,000 a year in terms of residential, inside of a care community with round-the-clock care. That could easily be $100,000 a year.
You're getting into my stuff.
Yep. And so where we start, and I'll turn this over in just a second. Your parents might have $50,000 a year coming in from Social Security and pensions. This comes down to that comparing the income and assets and expenses. That means you'd have about $50,000 a year for 5 years that would need to get covered. So overall, that's a $250,000 expense that we need to start planning around, strategizing around.
Exactly. And so keep that number in mind too. We're going to use that as our example. $250,000 is what your exposure is, or what your parents' exposure is. And the question now, where does that number come from when you think about, so I'll give you my example. My mom and dad moved into an assisted living independent care. So she started out with, she was diagnosed with Alzheimer's, early stages, in 2007, and dad was independent. And then we found a care community that would allow them to bump up. So she went to memory care, but he was just still living with her, but the care levels went up. So he went to assisted because he needed help with medications. Well, we started out at maybe a price of $6,000. And then as they moved up per month, it became $7,000, $7,500. When mom passed, she was at $5,000 alone per month. So you do the math, and that's actually pretty reasonable. And a lot of people say, oh, well, we want our loved one to age in place, and in other words, stay at home. Well, I was just talking with a home care service, and I said, how much is 24/7 care? Because with Alzheimer's, you have to have 24/7 care. You've got to have them eyes on all the time. And so she said, for one caregiver, 24/7 is $100,000 a year. All of a sudden, the care communities looked really appealing, right? So that's where this money, this financial side of things comes from. So let's talk a bit about, you'd mentioned about long-term care, and I can't tell you how many people I've said, I've alerted them to this amount of money, and they're like, oh, long-term care will take care of all of it. And plus I'll have Medicare. Well, first of all, Medicare only covers like medical expenses, prescriptions, and that type of thing. And then, long-term care policies, well, it depends, right? It depends on what's in your policy and how much you're spending on it. So can you give us a bit more detail on that, since so many people are not necessarily aware of what's in their policy and what it will cover and what it won't?
Absolutely. Yeah, and the very first thing that's important to note is that every single policy is unique, and the policies that were issued 20 years ago are very, very different from the policies that have been issued over the last 5 years. There's been a lot of changes in that industry. As a general rule, they are much less generous than they used to be. So if you have an older plan, it probably has a higher level of benefits than the newer plans. So definitely contact a representative from the insurance carrier first thing to get a better understanding of the policy that's in place. But I'll review a couple of the key elements so that you can kind of, if you happen to see a statement, you'll know exactly what you're looking at. So the first thing is the eligibility, or what triggers the coverage. Typically, the policies are based on the inability to perform tasks of daily living. So these are things like eating, dressing yourself, bathing. Usually it's a 2 or 3 factor test. So if you get to the point where 2 of those things can't be accomplished on your own, then the policy would kick in and be eligible to pay benefits. The next key factor in the policy is the waiting period, or the elimination period. That can be a 30-day period, 90 days, or 180 days often. So that's kind of like a deductible. That's the time that you need to be incurring and paying the expense before the policy actually starts to pay. And then the next element is the benefit itself. They usually quote this as a daily benefit. So the policy will say $100 a day or $200 a day. And sometimes they will be a fixed amount. Sometimes they will increase with inflation. Sometimes they'll have a 2% or 3% inflation rate baked in. So that's important to understand how much it's going to pay. And like I said, some of the old policies were much more generous, where they would actually pay for life. A lot of the insurance companies were losing a lot of money on those policies, so they're much more restrictive. You'll typically find a 2-year, 3-year, 5-year maximum benefit period. So once you get a handle of those variables, what I like to do is take a look at your total maximum benefit from that policy. So if you had a $100 a day benefit for 3 years, you can kind of back at the envelope, do the math. That's about $100,000 of benefits. So if we go back to that first example we were talking about, if your big picture exposure was $250,000, the long-term care policy at $100 a day would knock down that total exposure to about $150,000.
Okay, that makes sense. And but it's also alarming at the same time. So, because especially if you're under the assumption as a child of a parent who's either indicating signs of aging. I mean, it doesn't even have to be Alzheimer's, but any sort of aging where they're going to require additional care. We need to make sure that we're prepared as their children to help manage those finances. So thank you for that. I appreciate that. The average cost, just so you guys know, so that we have a perspective on this as opposed to a hypothetical example. According to the Alzheimer's Association, the average cost from the point in diagnosis to the 4 to 8 years that from the diagnosis to the end of life is $366,000. Now, Facebook ads would not allow me to put a number in. So if you're here as a result of that, that's the reason why you might not have seen that number or seen it in any sort of promotion on social media, but it's a big number. And and that's the average. So if you think about it, depending on where you are in the country, where you are in the stages, right? Because women make up 62% of the individuals diagnosed with Alzheimer's. So you think about the fact also that women are diagnosed closer to mid-stage rather than early stages. That's when they're going to need more care. It's going to be more expensive. And then the flip side of this, and correct me if I'm wrong here, Justin, is that if you wait too long to either buy long-term care insurance or to move into a care community, that they can turn you down. So long-term care insurance companies can turn you down, and the care community can say, you are too far gone and you're not, your loved one is not in a situation where we can care for them anymore. And then you go straight from no care or very limited care costs, or you're doing it on your own, to exponential care because of that disparity. Is that correct on the long-term care insurance? Okay.
Yeah, it is very, very challenging and incredibly expensive to just get a new policy. If you're, especially, you will have no chance of getting one if you actually have a diagnosis. But even if you try to start in your late 60s or 70s, the premiums will be very, very high. The benefits will be not that generous. And with a long-term care policy, one thing that's also important to note is most policies now have a lifetime payment. So you have to pay every single year, and you need to be committed to paying that premium every single year in order for the policy to stay in force when you actually need it. So yes, planning early and making those moves maybe a little you either have to be early or you're late. And as Pam said, there's a lot of bad things that can happen if you're late. So it's much better to opt on the side of early.
Yes, absolutely. So let's talk more about how we're going to make these these payments, and who will pay for them. There's several options as to how to structure the amount of money that our loved ones have set aside, and to make sure that, like in my dad's case, he was so concerned, you guys won't have any, you won't have any money left over for you. What are ways that we can kind of look at how we set aside money, and who best is it to pay for care? Can you help us out with that a bit?
Yeah. And this is where things start to get pretty tricky. And this is where it is very, very personal to the individuals and the family, because there's no cookie cutter advice here. But there are a couple things to keep in mind that will help shape the way you think about this. The first thing to think about is that a lot of these expenses are tax deductible. So the one silver lining here is that you can pay for this, and if you do it the right way and you structure it the right way, you can get a tax benefit from it. But we'll explore that later. When you have the parents with enough assets to cover the expenses, like we were talking about, that $150,000 exposure, maybe it's 250, maybe it's higher. But if you can kind of figure out what that exposure might be and see that, yes, the parents have enough assets to cover that, the question I like to start with is, which bucket should we start pulling from to pay that expense? Because when I want to think about this in the context of total family wealth, that's the way the parents are thinking about it. They want to, live a comfortable life, but they also want to take care of their children.
Right.
So I like to think about this from a multi-generational perspective, and I want to be able to use that tax benefit as well. So oftentimes the parents will have retirement accounts like IRAs. They'll have taxable accounts like a brokerage account or savings accounts, and then they'll have their real estate. So I like to do is kind of triage which one of those buckets are we going to start pulling down from first. And again, this is helpful to have that total exposure in mind, so we might have to spend down all of this bucket, all of that bucket, and only have one bucket left. And that's where it comes into play. Usually, I like to see the parents spending down retirement accounts first. And this is why. Uncle Sam has a lien essentially on your retirement accounts. The money gets taxed when they come out of there. So instead of leaving the retirement accounts to the children, where the children are going to have to pay the tax, let's spend down those retirement accounts while you have this big deductible expense. So it's almost, in a way, because the money that you're pulling out is going to pay for care, it's deductible, you get to pull money out of those retirement accounts tax-free, essentially.
Yeah.
And that can make a big difference, as opposed to spending down a more tax-favored asset and then leaving the kids. You basically helped Uncle Sam in this situation, but not yourself or your family.
Good point. Good point. So one of the things that I did right before mom passed, but I didn't know that was happening. So her rates were going up to $5,500 a month. And um, that was very emotionally stressful, by the way. This whole conversation, whether you're having it with your parents or you're in a situation now, as I was, where it's like, where's that money going to come from? Because they had no long-term care insurance. They just had Medicare and military benefits, which is something else that if you read the book, It's Not Simple, I do have links to the VA benefits and the military benefits and that type of thing, so that you can look those up if you have a military veteran. But the next thing was I actually started to refinance my house because I was looking at, what's the best way to handle that? It was to take the money out of my home to pay for my mom's expenses. What situations are there in that respect for kids paying? And is there any upside to that?
Yeah. So when the children are paying, we need to be careful because oftentimes the children will pay to the detriment of their own financial security. We want to be very careful with that. And that's a tricky situation. But if the kids have ample assets and can certainly afford to make those payments, one thing we want to watch out for is gift tax issues, actually. You're limited in the amount that you can make as a gift to your parents every year without incurring gift taxes. There's an easy workaround. You can pay directly to the care provider, and that will avoid it. So that's just a little thing to be cognizant of. But if you're not careful and you're writing the checks to the wrong people, it can end up having gift tax implications for you. And you mentioned housing. I think that's another really important thing, because when we're dealing with couples like this, usually the house is within the top 3 of their largest assets. And it gets tricky because you're using your house for 2 things. You're using it for a roof over your head, and it's also a piggy bank. And it's difficult at this stage in life to use it as both. So oftentimes people will look into maybe refinancing. That can be tricky, or taking out a home equity line. We just saw, in the last couple of months, home equity line lending standards tightened up dramatically. So I always think it's very challenging to make that a fallback plan, because the banks can change their lending standards at any point in time. Interest rates can change. And also, you need to generally qualify for a refinance or for a home equity line. If your parents just have Social Security and pension, the banks will look at that income and say, there's just not enough here for us to feel comfortable lending. So then you get into a tricky situation where it's my biggest asset or the parent's biggest asset might be the house. They need somewhere to live, but the equity is locked up. Oftentimes, if we know that going into a care community is going to be a necessity, that's one of those things where you might have to make the decision earlier versus later to sell the house and move to the care community. Another thing to think about, if one of the spouses is going to be in the residence for a longer period of time, so let's say one of the parents has a diagnosis and is going to need extensive care, but the other spouse has a very long, 20-year health span potentially ahead of them, and they want to stay in that house, then again, we get into the situation where we don't have a good means to access the home equity.
Right.
Situations like that, a reverse mortgage can be something that's worth investigating. Now, there's a lot of stigma and myths around that. We won't go too deep into that. But
there's another webinar for that.
That's a whole nother one, yeah. But if somebody's planning to stay, or one of the spouses is going to be staying in the house for an extended period of time, that often is your only option to unlock some equity, still have basically get the best of both worlds, where you keep the roof over your head and access to the liquidity at the same time.
And it's really all about timing. So please note that what we're talking about today is not specific advice to you. You have to consult with your specific financial advisor or reach out to Justin. What we're doing here is kind of letting you know, building awareness of the exposure that you or your loved ones might have. So that's an important point, is that but I'm also sharing my real life story. So that it has credibility around, this isn't just hypothetical, this is actually real life stuff. One of the other things that, and then we'll wrap up, one of the other things that we ran into was dad passed before mom, even though he was more capable. So what's the quick scoop on Social Security and what happens with that?
Yeah. So the way it usually works is, survivor benefits are complicated and there's a whole different set of rules. But in the vast majority of situations, when one of the spouses passes, when they're both collecting already, so this is generally, we're talking people in their 70s and 80s, you'll have one with a higher benefit, one with a lower benefit. When we're dealing with, the greatest generation, the early baby boomer generation, typically it's the husband was working, he has the higher benefit, the wife has a smaller benefit.
Mm-hmm.
When somebody passes either one, essentially the larger benefit remains, the smaller benefit goes away. So if mom had a small benefit, let's call it $1,000 a month, and dad had $2,000 a month, and dad passes away, mom would then be getting $2,000 a month.
Got it.
If dad was getting the $2,000, mom was getting $1,000, and mom passes away, dad's just going to stick with the $2,000. So you're basically going to lose the smaller of the two Social Security benefits.
Okay, that's really helpful. Thank you for that. So does anybody have any questions? I don't see anything in the chat room. So you can either unmute yourself to ask a question, or I can unmute you. So let me know if anyone has any questions for Justin or for me. Doesn't look like it. Of course, everybody's scrambling for their mute buttons. So let's go ahead and wrap up. And then if you guys can find the mute button or unmute button, let me know, or put it in the chat that you're trying to reach us. So Justin, one of the things that I hear a lot from people is, do you know somebody who can have this conversation with me? So how do people reach you and have this conversation?
So the best way to find me is through my company's website, Savant Wealth Management. And again, my name is Justin Smith. So I'm easy to find and contact there, savantwealth.com. I'm also on LinkedIn, connected with Pam, obviously, and Justin D. Smith on LinkedIn. There's a handful of Justin Smiths out there, but Justin Smith with Savant Wealth, you type that in anywhere you're at and you'll find me.
Great. And of course, if you have, need to get a hold of him, I happen to know how to get a hold of him as well. So whichever one of us you can remember, one of us knows how to get a hold of the other one. So just as a reminder, for getting a hold of me, I am on It's Not That Simple. And that's the Facebook page. I'm also on LinkedIn as Pam Ostrowski. And if this was overwhelming, then please buy the It's Not That Simple, Helping Families Navigate the Alzheimer's Journey book. I have been told it has 34 5-star reviews right now on Amazon. And I have been told this book is great for any elder care situation, of things of how to get prepared for elder care, as well as what the journey is going to look like to kind of prepare you. So hopefully you found this helpful, and we look forward to having you guys join us again in future webinars. Thank you so much for attending. I appreciate it. Take care. Bye-bye.
Thank you.